Welcome to the Teaching You to Fish podcast, financial literacy for the rest of us. My name is Carl Fish, and I'm the host of this podcast. This is episode 11, Investing, Part 1. Vocabulary. Investing freaks people out. There's so much information out there that it can be overwhelming, and because they fear making a mistake, many people end up making poor investment decisions by not making any investment decisions. The good news is that investing is actually one of the simplest parts of your financial life. When I say that, most people look at me in surprise, but it's true, so let me say it again. Investing is actually one of the simplest parts of your financial life. Most of the other things we'll talk about in this series are much more difficult, including making the decisions necessary to come up with the money to invest in the first place. But as long as your income exceeds your expenses, as discussed in episode 2 when we explored the basic equation of personal finance, then investing that surplus is surprisingly straightforward. Like many areas of knowledge, investing comes with its own vocabulary, and that vocabulary often ends up becoming jargon that people throw around assuming everyone knows what it means. While I don't think investing's jargon is all that difficult to learn and understand, it can be very confusing when you don't know the terms to begin with. So this episode is going to be all about investing's jargon, the vocabulary you need to know in order to have further discussions about how to actually invest. And then future episodes will get into the specifics of how to invest. Learning vocabulary may not be the most exciting part of this podcast series, but it's a critical and necessary step in order for you to learn how to invest your hard-earned money. Note, as you listen to this podcast, there's a lot of vocabulary, and it may feel overwhelming. If so, you might consider opening and reading the transcript instead. This is because you can go slower reading about each term that is unfamiliar to you, and because each term is linked to a more thorough explanation. While investing is a commonly used term, many people aren't really clear on the differences between saving and investing. As discussed in episode 2, the main difference between saving and investing is your time horizon. Savings is money you set aside for possible short-term use, including the expected expenses that go along with your lifestyle, as well as saving up for a specific purchase, like perhaps a car. This is typically money you anticipate needing within the next 5 years. Investments is money you set aside for the long term, generally considered to be more than 5 years, and is typically used for things like your retirement or paying for a child's post-secondary education. In general, you want to take little or no risk with your savings, but want to take more risk with your investments, which means we need to talk about risk. The interest you earn in a bank account, money market account, or CD has very little risk because it's generally backed up by the U.S. government. This is why you put most or all of your savings in these, because your balance will likely never go down and will increase slowly over time. For savings, which are shorter term, this is what you want, because you don't want to take the risk that your balance decreases significantly right before you need the money. But for investments, which are longer term, you do want to take more risk because the expectation is that you will get a much higher return by taking those risks. Because you don't need this money in the short term, you can ride out any decreases in your balance and end up way ahead in the long run. The typical way of measuring investment risk is volatility, how much the price of a particular investment varies. While that's helpful in understanding short-term risk, it's not that helpful in measuring longer-term risk. You shouldn't care that much about short-term price changes as long as the expectation is that over the long term the price, and therefore the value of your investment, will be much higher, which is why the terms riskier and safer are historically a short-term distinction. So another way to measure risk is asking, how likely is it that I will meet my long-term goals? As it turns out, a big factor in whether you meet your goals is your individual risk tolerance. How much short-term volatility can you handle emotionally and still stick with your investment plan? This is behavioral risk. Do you have the knowledge and the discipline to stick with your investment plan when your investments go down in the short term? Sequence of return risk is the danger that your portfolio experiences negative returns right when withdrawals are first happening, typically early in retirement. This is a risk because when the market eventually recovers, you won't benefit as much because of your lower portfolio value. And this can result in a lower amount available for you to spend in retirement. This risk is highest in the first 5 to 10 years of retirement. Longevity risk is the risk that you end up living much longer than what you expected. While living longer is generally a good thing, it can cause problems when you haven't planned adequately for this financially, and it can result in having to lower your standard of living later in life. When you invest, you take into account your time horizon, your risk tolerance, and what your long-term goals are. And then you decide on your asset allocation. Your asset allocation is how you divide up your investments between different types of investments, with those different types having different levels of volatility and different expectations for long-term returns. These different types of investments are called asset classes and include classes such as stocks, bonds, and real estate. Your asset allocation can change from your initial allocation as the different asset classes can grow at different rates. In order to get back to your desired asset allocation, you sometimes rebalance, which is selling some of the asset class that has grown more in order to buy some of the asset class that has grown less. When you buy stocks, you purchase shares in a company, making you a partial owner of that company. They are often also referred to as equities. When you buy bonds, you loan money to a company, and they pay you interest. The price, and therefore value, of the bond can also go up or down. They are often referred to as fixed income. When you buy real estate, you invest in property, typically including land and structures. This can include your primary residence as well as investment properties. It can also include investing in stocks or bonds that are themselves invested in real estate holdings. There are many other asset classes, but those are the only ones most people need to know about. When you purchase stocks or bonds, you can purchase an individual stock or bond, where you buy shares in or loan money to one particular company. But the preferred method is to buy stocks and bonds in many companies, which is called diversification. Don't put all of your eggs in one basket. The easiest way to do that is through a mutual fund, which pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Similar to a mutual fund is an exchange-traded fund, or ETF, which also pools money from many investors to purchase a diversified portfolio. The difference is that mutual funds are bought and sold at the closing price each day, whereas ETFs can be traded throughout the trading day, just like individual stocks and bonds. Note, for simplicity's sake, I will just refer to both mutual funds and ETFs as funds from here on out. Funds come in two major styles, active and passive. Active funds are where the investment manager actively tries to pick individual stocks or bonds that they think will be winners and therefore will achieve a better return. Active managers tend to buy and sell their holdings much more often. Passive funds simply buy all of the stocks or bonds in a particular segment of the market. Passive managers buy and sell much less frequently, a strategy often referred to as buy and hold. The most common type of passive investment is called an index fund. There are a variety of indexes that have been created to mimic a particular portion of the stock or bond market. As an example, the S&P 500 is probably the most well-known index, and it invests in the 500 largest companies in the United States. Instead of actively picking and choosing among those companies trying to pick the winners, it simply buys all 500. These funds essentially try to duplicate the return of their index, and the index itself is used as their benchmark, which allows you to compare the performance of similar funds. There are many different indexes with different benchmarks, and so therefore many different index funds. When you invest in active or passive funds, there are fees and expenses involved. While this can vary, in general you can be charged fees for particular transactions, like making a purchase, and you can be charged an administrative fee on your overall investment account itself. The administrative fee is sometimes a fixed dollar amount and sometimes a percentage of assets under management, or AUM. The funds themselves also have an expense ratio, which is a fee where a, hopefully, small percentage is deducted from your returns for the operating expenses of that particular investment. Fees and expenses subtract from your overall returns on your investments. The goal of investing is to grow your money and earn a return on investment. Returns are reported in four main ways: gross return, net return, after-tax return, and real return. Gross returns are what your investments earn before all fees, expenses, and taxes. Net returns are what your investments earn after fees and expenses, but typically don't include the impact of any taxes you owe. After-tax returns take your net returns and reduce them by any taxes you may have to pay on those returns, often referred to as tax drag. All three of those are typically reported as nominal returns, which is the return you receive in dollars, but which doesn't take into account inflation. Real returns are the returns you receive when you do take into account inflation, so is the return that best reflects the purchasing power of your money. Simple returns are typically reported over a specific time period. Compound interest is when your returns themselves earn returns, and compound annual growth rate CAGR, takes into account compound interest and shows you what your return each year would have been in order to achieve your total return over a specific period of time. Different asset classes have different expectations of their long-term returns. For example, bonds are expected to earn more than cash, but less than stocks over the long term. Different asset classes also have different correlations, meaning that they typically don't grow or decline at the same rate at the same time, which is one of the benefits of diversification across asset classes. It lowers your portfolio's overall volatility. Asset location is where your money is actually located. You invest your money through certain companies, either on your own, individual accounts, or through your employer-based accounts. That company is referred to as a custodian or sometimes a record keeper. Individual accounts include taxable brokerage accounts, individual retirement accounts, IRAs, and sometimes health savings accounts, HSAs. A taxable brokerage account is an account you hold at a licensed brokerage firm, custodian, such as Vanguard or Fidelity. An individual retirement account, IRA, is also typically held at a brokerage firm and is a tax-advantaged account, meaning that it offers some tax benefits such as a reduction of your taxes now, deferred taxes on any earnings along the way, and/or a reduction on your taxes later. We discussed health savings accounts, HSAs, in episode 6. These also have tax advantages and can be held through your employer, on your own, or both. A 529 college savings plan is a tax-advantaged account that allows you to save and invest to help pay for post-secondary education costs. For all individual accounts, you have complete freedom to choose which companies you invest with. Employer-based accounts are investment accounts offered through your employer, which means you are limited to investing with whichever vendors they offer. Not all employers offer employer-based accounts. These are typically tax-advantaged retirement accounts, such as 401ks, 403bs, or 457bs, but employers may also offer an HSA. Some employers offer an employer match, where they match some or all of your contributions to employer-based accounts. We'll talk more about these accounts in future episodes, but briefly, a 401k is a tax-advantaged account that is usually offered by private employers, although some public employees have access to 401ks through a state-sponsored plan. A 403b is the public and nonprofit employer equivalent of a 401k, although there are some differences, and unfortunately, they often have much higher fees. A 457b is an additional tax-advantaged account that is sometimes available from public employers and, while similar to the 401k and 403b, has some attractive advantages such as earlier penalty-free withdrawals. We'll talk much more about these different types of accounts in future episodes. Asset tax status refers to how and when your investments are taxed. Taxable brokerage accounts are not tax-advantaged and are currently taxed accounts, so you get taxed as soon as you receive any earnings from your investments. These earnings are either dividends or capital gains. Dividends are when a company distributes some of its profits to shareholders, typically on a quarterly basis. They come in two flavors, qualified and ordinary. Qualified dividends have to meet certain requirements and are taxed at the lower capital gains tax rate, whereas ordinary dividends are taxed as ordinary income, as discussed in episode 10. Capital gains are gains your investments earn from the price increasing, capital appreciation. Realized capital gains are capital gains that you receive when an asset is sold, either by you or by the investment manager of the fund. Unrealized capital gains are also gains that your investments have earned due to capital appreciation, but you haven't been paid them yet because the shares have not been sold. These gains are not yet taxed and will only be taxed when you sell those shares and realize the gains. Short-term capital gains are for assets you have held less than 1 year before selling, and these are taxed as ordinary income. Long-term capital gains are for assets held longer than 1 year before selling, and these are taxed at the lower capital gains tax rates. Any unrealized capital gains you have at the time you die get a step-up in basis, meaning whoever inherits the account does not have to pay any taxes on the unrealized gains. When you hold your investments in tax-advantaged accounts, however, you do not owe any taxes on dividends or realized capital gains when they happen, because these accounts are tax deferred. So when dividends and capital gains are paid in accounts such as IRAs, 401ks, 403bs, and 457bs, you do not owe any tax immediately. Tax-advantaged accounts come in two flavors, traditional, pre-tax, and Roth. Traditional tax-advantaged accounts are not yet taxed and allow you to deduct any contributions from your income now, lowering your taxable income and therefore your taxes at the time of contribution. Any growth in the account due to dividends or capital gains is tax deferred, and you only owe taxes when you make any withdrawals from the accounts. Those withdrawals are then taxed as ordinary income at your ordinary income tax rates. Roth accounts are already taxed. You do not deduct contributions from your income taxes, so you do not get any tax break now. Any earnings along the way are not taxed, and when you make withdrawals from the accounts, the withdrawals are not taxed. We'll talk much more about these accounts in future episodes. When you make a withdrawal from an investment account, especially retirement accounts, it is called a distribution. Traditional pre-tax retirement accounts also have required minimum distributions, RMDs, which you currently have to take starting at age 73, increasing to 75 in 2032. When you retire, you typically switch from the accumulation phase, where you're typically working and adding to your investments, to the decumulation phase, where you're typically beginning to sell your investment assets in order to provide cash flow in retirement. In addition to pulling from your investments in retirement, most people have Social Security or a pension, or both. Both of these provide guaranteed monthly income for life, sometimes with a cost of living increase, COLA, that increases your monthly benefit each year. Both Social Security and a pension have rules around when you can receive benefits and how much you receive. Full retirement age, FRA, is the age at which you receive your full benefit and is currently 67 for Social Security and varies with each pension plan. Early retirement is when you choose to retire and start drawing your Social Security or pension benefits before FRA. Both Social Security and pensions sometimes offer spousal and survivor's benefits. A spousal benefit means that your spouse can receive a benefit based on your benefit while you're still alive. A survivor's benefit means a spouse, and sometimes other dependents, can receive a benefit based on your benefit after you die. The rules around spousal and survivor's benefit for Social Security apply to everyone who receives Social Security. The spousal and survivor's benefits available with a pension vary based on the individual pension and the retirement option you choose. Some people choose to purchase an annuity with some of their investment earnings, which turns a lump sum of money into a monthly payment that is similar to Social Security or a pension. Estate documents are documents you need at the end of your life. They typically include a will or a trust. A will declares how you want your property and assets distributed at your death. A trust is similar to a will, but more complicated, and gives control over any assets and property that you've added to the trust to a trustee. Most of your financial assets can pass to your heirs outside of a will or trust, often referred to as outside probate, as long as you have named designated beneficiaries for each account. If you've done that, then only whatever property, including stuff you still own, is handled by the will or trust. A power of attorney gives someone else the ability to act on your behalf if you are not capable of acting. A healthcare directive specifies what your wishes are regarding critical care at the end of your life. That's a lot of vocabulary. But if you take your time, each term should be reasonably understandable, and knowing the vocabulary is necessary for future episodes where we talk about how and where to invest. And you can always refer back to this episode as needed. As I said at the beginning of this episode, investing is actually one of the simplest parts of your finances, but only once you know the vocabulary and a few other simple concepts that we'll talk about in our next several episodes. I believe that once people have this knowledge, they are perfectly capable of investing on their own, but some people want to have help with investing. So the last piece of vocabulary in this episode is defining the various kinds of help you can receive. A financial planner or financial advisor is someone who helps you with all of your financial decisions, including, but not limited to, investment advice. An investment advisor only helps you with your investments, not the rest of your financial decisions. For either of these, you want to make sure they are a fiduciary, which means they have to act in your best interests and put your interests ahead of their own. Unfortunately, some planners and advisors are not fiduciaries, in which case the more appropriate way to think about them is salesperson. This is especially true in the education space with many 403(b) representatives. If you choose to get help with your investments, it is essential you choose a fiduciary and that they are transparent with you about the fees you are charged and how they are getting paid. If you are taking notes throughout this series, write a paragraph or two reflecting on this exercise. If you're comfortable sharing your reflection, there are several ways to do that. If you're watching or listening to this on Spotify or YouTube, then you can leave your thoughts and/or your feedback or questions in the comments. You can also always reach out to me directly on social media or via email. I'm Carl Fish on Blue Sky, Twitter, Facebook, and YouTube, or you can email me directly at carlfish@gmail.com. Our next episode will be part 2 of our look at investing, focusing on asset location, allocation, and tax status.